Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Okay, happy Wednesday everybody. China has once again seen its worst plunge in exports since the initial shock of the pandemic, once again undermining confidence in its 2023 recovery. According to official numbers published by the Customs Administration yesterday, Tuesday, in July exports dropped 14.5% in dollar terms year on year, the worst decline since February 2020 when the nation went into its first lockdown. Imports contracted 12.4%, leaving a trade surplus of $80.6 billion for July. The export and import figures were both worse than what economists had anticipated, according to both a UK-based Reuters poll of economists as well as a US-based Bloomberg poll of economists. By this point, every man and his dog knows the reason for the decline: weak international demand, even weaker domestic demand, and geopolitical tensions. Quote, "The slump in imports is a reflection of weak domestic demand. The overall consumption and investment growth probably both stayed quite weak in China." End quote. Even previously more optimistic voices on the Chinese economy are now sounding more concerned. Quote, "The imports data was pretty bad. On our estimates, pretty much all the recovery in import volumes since the start of the year was unwound in July, which is concerning, to say the least, and suggests the domestic picture was weakening quite rapidly in the last month or two." End quote. July was the 5th consecutive month of falling imports, showcasing that Chinese consumption remains stubbornly weak. Exports have declined year on year in each of the past 3 months, dropping 12.4% in June. Manufacturing activity has also contracted for 4 straight months, according to Purchasing Managers' Indices. Some analysts have attributed the decline in imports to falling commodity prices too. South Korea, Japan, Taiwan, South Africa and Canada all saw huge drops in Chinese imports, which of course will be acutely felt by the relevant industries in these places. Imports from the US fell 11.2%, while those from the EU were down 3%. US decoupling policies in part contributed to the bite. In July, exports to the US from China plummeted 23% year on year. The questions of growth targets and stimulus measures, which we have seen being asked again and again these last few months, is yet again on the lips of economists. Quote, "The government's pro-growth pledges are encouraging, but without powerful follow-through that turns plans into action, weakness in the second half could sink prospects for achieving this year's 5% growth target." End quote. Soon after the numbers were published, Peking University's Professor of Finance, Michael Pettis, observed that while exports were worse than expected, it is worth noting that in July 2022, that is last year, China recorded its highest monthly levels of exports in its history, so the drop is from a high base. He gives a more nuanced picture of the situation. Quote, "Although exports continue to be very high and far above export levels before the pandemic, it is pretty clear that exports and the trade surplus will not be the sources of growth in 2023 that they were in 2022 or in the 3 to 4 previous years. Total exports year to date were $1.97 trillion, 4.8% lower than they were over the same period last year. Total imports were $1.57 trillion, 7.5% lower than last year, indicating that as weak as export growth has been this year, growth in domestic demand has been even weaker. Over the rest of the year, most economists expect Chinese exports to continue slowing, given weakness in foreign demand and especially in Europe. Imports will also slow, although probably not as much as exports. That's because China's continued supply-side measures imply that domestic demand will remain weak relative to domestic production. I'd guess that by the end of 2023, in spite of much lower exports relative to 2022, China's trade surplus will be approximately the same size." End quote. Next up, Chinese financial media outlet Caixin has published a report looking at the collapse in employment in China's once lucrative private tutoring industry after a devastating crackdown on the industry back in 2021, which we covered at the time here on China Update, although I believe at that time we only had about 600 subscribers on the channel. In mid-2021, Beijing rolled out a policy banning for-profit tutoring in core curriculum subjects for K-9 students. The campaign aimed to reduce the homework burden on students as well as the extra pressure of after-school tutoring. The industry and investors were completely taken off guard. Within a few weeks, billions of dollars of market values were wiped as many companies saw revenue drop 60 to 80%. The report from Caixin finds that some of China's biggest listed education companies have slashed their workforce by more than 80% over the past 3 years. US-listed TAL Education Group, a leading K-12 tutoring provider, reduced its full-time workforce by 83.5%. New Oriental Education, another giant in the sector, cut its employment by 1/3. East Bay Holdings Limited saw an 87% collapse in employee numbers over the 2-year period ending May 2022, and 51 Talk, an online English teaching platform, saw a 93% collapse in employment. This all in part explains, to some extent, why youth unemployment is so high. Private tutoring, along with other sectors like technology companies, was a popular industry for recent graduates. Indeed, according to estimates by researchers at the Chinese Academy of Social Sciences, approximately 1.64 million people working in the education sector are expected to lose their jobs this year alone. More than half are between the ages of 16 and 24. Next up, another concerning report on China's population decline. Hey everyone, if you enjoyed today's episode of China Update, don't forget to hit that like button. About 50% of regular viewers are not subscribed, so if you enjoy this sort of content and you like to watch it on occasion, maybe consider subscribing. Sharing this content is also a massive way to help the channel grow, and for anyone who can go the extra mile and help keep the channel financially sustainable, Patreon and Buy Me a Coffee links are in the description below. As always, thank you so much, everybody, for the ongoing support. And finally, for today's episode, this week, Richard Jackson, president of the Global Aging Institute with US consultancy Terry Group, published a special report on China's demographic decline. This is a topic that most are very familiar with. We end today's video by examining some of the observations made in the report, from which we will now directly quote several salient excerpts. Most countries enjoy a period of favorable demographics midway through the demographic transition, but China's demographic dividend was unusually large because its fertility decline was unusually steep. In 1970, the Chinese total fertility rate was a towering 6.1. By 1991, just 21 years later, it had fallen beneath 2.1. The so-called replacement rate needed to maintain a stable population from one generation to the next. As of 2022, China's total fertility rate was just 1.2, making it one of the lowest fertility countries in the world. As China's fertility rate fell, its youth dependency burden plunged and the share of the population in the working years soared, rising from 46% in 1975 to a peak of 66% in the early 2010s. To be sure, China's favorable demographics alone did not guarantee its economic success. Policies matter too, and China pursued the right ones, like Japan, South Korea, and other so-called East Asian tigers before it. China implemented an export-led growth strategy, starting with basic manufacturing. At the time the one-child policy was in place, no one in the Chinese government gave much thought to its ultimate consequences. The challenges posed by population aging and population decline lay far over the horizon in the distant future. Today, however, that future has arrived. The number of elderly is now increasing much faster than the number of children is declining, pushing China's overall dependency burden back up. In 1975, there were 13 times as many children as elderly in China, By 2050, the UN projects that there will be twice as many elderly as children. As recently as 1990, just 5% of China's population was aged 65 or over. Today, 14% is. In 2050, 30% will be. By then, China will be a considerably older country than the United States. China's population is not only aging but is also entering a gathering decline that will be difficult, if not impossible, to reverse. By 2050, the UN projects that its working age population will shrink by 1/5. By 2100, unless birth rates or immigration increase substantially, it could shrink by 3/5. Already by the 2030s, China will be losing an average of 7 million working age adults each year. By the 2050s, it will be losing an average of 12 million. Even as fiscal burdens rise, economic growth will slow. If China's economy were otherwise healthy, it might be better prepared to run the coming demographic gauntlet. But in recent years, it has fallen prey to a host of ailments. According to the IMF, productivity growth, the other driver of GDP growth, has slowed dramatically since the early 2010s. Many other East Asian countries have fertility rates that are as low or even lower than China's. This suggests that China's fertility rate would have fallen on its own even without the one-child policy. While this is no doubt true, it would not have fallen so sharply. Today's developed countries grew rich before they grew old. China is growing old first, which means that it may never grow rich. Along with the low fertility and middle income traps, there may be a third and even more perilous trap. Until recently, most projections showed that China would overtake the United States in economic size by the end of the 2020s, and eventually dwarf it later in the century. Given China's demographic and economic troubles, this scenario now seems increasingly unlikely. If China determines that the tide is turning against it, it may conclude that it must challenge the United States soon, or risk losing the ability to challenge it at all. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a wonderful day wherever you are, and I will see you all tomorrow.